Wow, QuantumScape's Q3 earnings really lit a fire under the stock, didn't they? So in this breakdown, we're going to get right into why. We'll dig into the numbers, unpack their core strategy, and talk about what it all means for where the stock could be headed next.
All right, so here's the game plan. First, we'll hit the big numbers that got everyone talking. Then we're going to unpack this whole capital light strategy they're pushing. After that, we'll check out their latest guidance, and we'll wrap it all up with our take on what's next, and of course, our rating.
So the market really liked what it saw, and you can boil it down to a few key things. They beat expectations, which is always good, but more importantly, we got the first real signs of commercial traction. Let's dig in.
Okay, first things first, the bottom line. QuantumScape came in with a smaller loss than expected. They posted a GAAP loss of 18 cents per share, which was 2 cents better than the 20 cents Wall Street was bracing for. It's a beat, and in this market, a beat in a beat. And you can see how the market felt about it. The stock jumped 8% right after the call, and on pretty heavy volume, too. That's a really strong signal, right? It tells you investors are buying into the story that management is selling. And this is a really big deal. They rolled out a brand new metric they're calling customer billings, and it came in at $12.8 million for the quarter. Now, to be clear, this isn't the same as official revenue just yet, but it's the first real, tangible sign that customers are starting to pay up. Think of it as a preview of what's to come.
So when you put it all together, you can really see the whole picture. You've got the earnings beat we just talked about, then look at their spending. CapEx under $10 million, which is super disciplined. And the kicker? They're sitting on $1 billion in liquidity. That's a huge cash cushion, enough to keep them going well into the future.
But honestly, it's not just about the numbers this quarter. What management really wanted to hammer home on the call was their core strategy. And that whole strategy revolves around this idea of a capital light ecosystem.
And here's how it works. It's actually pretty smart. So QuantumScape focuses on what they do best, the core innovation, that special separator technology. Then, instead of building their own factories, they partner with manufacturing giants. We're talking experts like Corning and Murata to make the separators for them. And the final step? The big car companies like VW take those parts and assemble the final battery cells. Pretty clever, right?
So here's why this is such a game changer. The traditional way is to spend billions and billions of dollars building your own giant gigafactories. It's incredibly expensive and risky. What QuantumScape is doing is, well, it's the opposite. They're trying to completely de-risk that whole scale-up process by letting their partners handle the heavy lifting. It's just a faster, leaner, and frankly, a much less risky way to get to market. And the CEO himself, Dr. Siva Sivaram, said it best. He said their goal is to provide a turnkey ecosystem. And this isn't just talk, either. They're backing it up with major new deals, like one with Corning and another with Murata. These are real partnerships, with ink on paper, making this whole ecosystem a reality.
Okay, so let's shift gears and look at their guidance. How does this whole ecosystem strategy actually translate into their financial forecast?
So you know how everyone needs to just focus on their cash runway? Well, management is trying to change that conversation. They made it really clear that the new metric to watch is customer billings. They want us to see this as the #1 sign of commercial progress, and, you guessed it, a sign of future cash coming in the door.
Now, the CFO did a good job of setting expectations here. He basically said, hey, everyone, don't get ahead of yourselves. Think of billings as a key operational metric, not a direct replacement for GAAP revenue. The accounting, especially with huge partners like VW, can get complicated. So the numbers might be a bit jumpy from quarter to quarter, and just because they send a bill doesn't mean the cash shows up that same day. Good context to have.
And the good news just kept on coming when they talked about their updated outlook. They tightened up their adjusted EBITDA loss range for the better, they trimmed their spending plans, and the really impressive part? They've now extended their cash runway all the way through the end of the decade. That takes a ton of financial risk off the table. All right, so let's put it all together. We've got an earnings beat. We've got a really clear, compelling strategy, and we've got improved guidance. So now it's time for our final take. What does this all mean for the stock? So here's the billion-dollar question, right? The stock has had this insane run-up already this year. So can this one good quarter really keep that momentum going and justify the stock price climbing even higher? Looking ahead, here are the key things we're going to be watching for. These are the catalysts that'll really move the needle. First, manufacturing progress. We need to see updates on their Eagle pilot line and real results coming from those partnerships with Corning and Murata. Second, we're looking for commercial momentum. That means more data on their cell shipments and, this is the big one, any news about signing up another top 10 global carmaker. So, based on everything we've seen this quarter, the real, tangible progress they're making in de-risking their manufacturing, and the fact that they're getting actual commercial traction, we are initiating our reading on the stock as outperform. And here's our prediction. The company is doing a fantastic job of changing the story. It's not just some far-off R&D project anymore. It's about real-world, near-term execution. And we believe that as long as they keep delivering measurable progress with partners like Corning, Murata, and VW, the market is going to keep rewarding them. Just a reminder, this analysis is for informational purposes only. It is not financial advice.